In a recent discussion, you mentioned that your approach is multi-factor, whereas most ETFs are single factor. Can you explain this in more detail? Now, let's start by looking at ETFs. And one very good one in particular, BMO Low Volatility Canadian ETF, the symbol on it is ZLB. Their mandate is quite simple. Identify Canada's 100 largest companies, the kind of companies that most people should be investing in, and then choose the 40 lowest volatility of those companies on the list. Then they rebalance mid-year, and then they run the screen again on an annual basis to repopulate the portfolio. Now, this ETF has performed really well over the last 5 years, returning 6.89% per year, but it's down 4.41% over the past year. Over the past 5 years, it has performed slightly under the TSX 60, which has produced a return of 7.36% per year. Its 3-year biggest sector holdings are financial services 22%, utilities 16%, and consumer defensive 16%. And we could, if you have questions, you can talk to us and we'll explain how those sectors work. Single factor ETFs produce great returns when the factor upon which they are based is trending positively. From 2011 to 2015, ZLB returned a whopping 86% total return to investors, but this was during a period of a falling Canadian dollar. During that period, the Canadian dollar dropped 28%, so you can attribute a big part of the total return for this investment to a currency gain. Now, this is a rather complex subject, and if you want to discuss, let us know and we can walk you through how currency affects the prices of Canadian securities. Now, during that period, 10-year interest rates dropped from 3.1% to 1.39%. As financial services and utilities do well during periods of falling interest rates, a portfolio that has high percentages of these companies will perform very well. It produced a total annualized return of 17% over this period. Since 2015, and without these tailwinds, ZLB has produced a total return of 42%, or roughly 8% a year, which isn't bad, but during 2020, it dropped 34%, which might not be a result that an investor who bought a low volatility ETF might expect. With interest rates at historically low levels, performance of this factor may not be the optimal positioning. We follow a multi-factor approach. We start with a 12-factor screen, looking at such things as stock performance, earnings growth, profit margins, return on equity, and company size. Then we look for companies with medium to long-term track records of strong earnings growth, where stock analysts believe that this trend will continue. Then we look for companies that are trading at reasonable prices and use technical analysis, as this helps us to spot where a company may have problems in the future. Multi-factor should help improve returns and reduce volatility over time.